Hello. Hey, we're live. Hey, Shades. Yep. Hi, Shades. How are you? Oh, Lolus. Hello. Hello. Hi, Shade. Hello. Hi, Walls. Okay, we're live. Hello, everyone. Welcome. Wednesday evening, our lives with a glass of wine. Hope you got your wine. Today, we're talking about understanding money basics. It's really important that we understand the language of money. You know, even the Bible says money answereth all things. So we're talking money today and we're really taking it basic. So apologize to the experts in the room. We're going to go right down to Money 101. So I'm going to start by explaining financial literacy. What do we mean when we say financial literacy? We're talking about two fundamental concepts. One is understanding the terms, the definitions of finance and accounting. And the second one is understanding the concepts and principles that govern accounting and govern finance. Welcome, Kems, Kemabom, Needle Point Woman. Nice to have you here. So I'm going to start by explaining the personal money basics, what you really must understand to get your personal finances together. And I'm going to start with explaining terms, concepts that you must have. We're going to start with your budget. It's crucial that you have a budget. And what is a budget? A budget is basically an analysis of your income and your expenses. And I'm going to explain what that is. But what your budget does is your budget helps you to keep track of your spending versus your earnings. You know, I always say you must never, ever, ever spend what you earn. So your budget helps you to really see that, to look at that. Aisha, you want to join me? Please come in here. So that's your budget. You can get a budget template if you sign up to my newsletter for free, where you make sure that on your budget you have for each month your income and your expenses, so you see what you have at the end of the month that you're carrying forward into savings
Hi.
and investments.
Hello.
Hello, Aish. You're on live.
Hi. How are you doing? Here. Can you hear me?
You hiding?
Thank you very
Yes,
much.
I
Good to
can
see
hear you. You're welcome. You're live on here with
you.
me,
Thank
and
you.
we're talking money basics. So you can ask a question, you can hop in and chime in. So I explained what a budget was and how important it is you have a budget, and your budget really shows your income and your expenses. And then we have your net worth statement. Now, your net worth statement is a statement of what you're worth. Now, just what you're worth financially. Your true worth is inestimable. You're a jewel of inestimable value. So your net worth is Aisha, do you want to hop out? Because I have you
Sorry, I really don't know how this works. So
here.
I don't know how, I'm just trying to figure it out. Um so I'm got my video on, right? And okay. Okay.
Yes,
So
you're online.
okay. Hi everybody.
Everyone
Hi. This is
you.
my first time, so I'm just learning. Okay, so what, put up my video so I can just listen? Okay. I'll do that then. Okay.
Yes,
Thanks.
if you want. Or you just hop out of
Okay,
the
cancel the
live.
live so I'll be
Just
listening in.
cancel.
Okay. I
And
don't know
then
how to do that. Carry on.
okay,
Okay.
just
Okay.
cancel, go out and then
Okay,
come
fine.
back in. And then
Leave.
Okay, sorted. So we talked about the budget. If you have questions, there's a question box at the bottom that you can put your questions on. Now, I was talking about your net worth statement. Your net worth statement is a statement of your financial worth, and it's basically what you own, all the assets that you own, less what you owe. Those are your liabilities. So I'm going to start by explaining what income is. What do we mean by income? Income is your earnings, what you earn every month, that amount of money that comes into you from your salary, your wages, your dividends, your interest income, all the income that you earn is your income, less your expenses. Your expenses are things like your rent, your food, your groceries, your shopping, and all those things are your expenses. So it's important that you compute those, and every month you have a statement of your income and your expenses, and always make sure that your expenses are far less than your income, so you have money left over to save and invest. I mean, what is cash? You hear people saying cash. When people say cash, we don't mean just the cash in your bag or your wallet. We also mean your bank balance. That's what's considered to be cash. The great thing about cash is it's immediately available for you to spend on your emergencies, on whatever. So we say in finance, cash is king. However, cash doesn't earn you a return. It earns you very little return. So you want to make sure that you don't keep a lot of cash. Keep just your emergency cash, and your emergency cash should be 3 to 6 months of your expenses is what you should keep in the bank as cash in bank. So we've explained your budget, your net worth statement. You now know what your income is, what your expenses are, and what your cash is, what you have with you. And then for your personal finance, on your net worth statement, you will see you have your assets and your liabilities. Your assets are those things, in quotes, in monetary value that you own, that belong to you, your home, your car, people that owe you money, we call your receivables. Those are all your assets. Now, assets belong to different categories, and I'm going to talk about 3 categories of assets. They're your fixed assets, or what we call your non-current assets. Those are assets that remain in your possession for more than a year. So like your car, your house, your furniture, those are fixed assets or non-current assets. You have them for longer than a year. Your current assets are the assets that translate and transform into cash within a year. So your inventory, for example, if you're running a business, we're going to talk business later. I just want to explain these terms to you so that you can compute your net worth statement. Now, the beauty of your net worth statement is it shows you what you're worth financially. So on your net worth statement, you've put in your assets, you've put in your liabilities, and the difference between your assets and your liabilities is what you own. It's also called your capital, and your capital is basically your net worth. So it's important that you understand that. Now, there's a term that you must understand to get to financial freedom, and that is what we call, can you hear me? Please put in a wave or a chat if you can hear me. It looks like I'm a bit frozen now. Okay? Can someone wave or put in a comment if you can hear me? Can you hear me? Oh, fantastic. Thank you, Pearl. So your investable net worth is really important. Some of us may have read Rich Dad Poor Dad, where Rich Dad Poor Dad brought out the really, really exciting concept of liabilities, where we thought, for example, the home we lived in, we thought was an asset. And Robert Kiyosaki said, no, 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 that is not an asset. That is a liability. Well, in a sense, the way he put it was good, because those things like your home, you're spending money, you're maintaining them, you're spending money on them. So they can seem like a liability. But in effect, they are assets because you can actually sell them and make money, but they are not investable assets. So one important thing I want you to take away from today is the concept of your investable assets. You must make sure that you start to accumulate assets that you can invest. Those are your investable assets. So when you have your money and you're trying to decide how to spend it, are you going to buy a luxury bag or are you going to buy some shares in a company? Your luxury bag is an asset that's like a liability. You're going to spend money on the polish and it's going to get worn. But if you take that money and you spend it on shares, those shares will earn income for you. So those are what we call investable assets. Investable assets are gold and they will get you to financial freedom really quickly. So always choose investable assets over other assets. So that's in terms of your personal finances and your personal money basics. Those are terms that you really must understand. You must be able to put your budget together. In putting your budget together, you list all your various forms of income, and you must ensure that you have more than one source of income. On another live, I'm going to talk about multiple streams of income and how you make sure you grow your income sources. And then you have your expenses. Now, when you look at your budget and you add up your expenses versus your income, always make sure that you don't spend more than 80% of your income. Always make sure you leave 20% or more to be invested. The quicker you want to get to financial freedom, the more you should invest. So that's it on the personal side. If you put questions in the box, I will answer your questions. And then I want to talk about the business side. Starting a business without understanding your money basics and understanding finances is like going to a country. Say you say to me today, I'm going to live in France. And I say, oh, that's great. You're going to live in France. Do you speak French? And you say, oh, no, I'm going to get an interpreter. That's what a lot of us do. I'm going to get an accountant. But you can't live successfully in the country if you don't speak the language. So yes, you might use an interpreter at the beginning, but you must ensure that you learn the language. And that's what money is. It's the language of business. So I'm going to start by explaining the concepts and definitions that you really must understand to succeed in business. And the first is going concern. The going concern concept states that your business is treated like a going concern. What that means is that we are assuming that your business is going to continue for the foreseeable future. So when you do your business accounts, you do them like your business is going to continue in the foreseeable future. That's the going concern concept. The next concept is the accruals concept. Now, the accruals concept is quite difficult for non-accountants to understand. We all understand the concept of cash, money that is in my hand that I have. But the accrual concept says that when you are expecting money that has been realized, say you've issued an invoice to a client, you can account for that because that is money that is accruing to you. So the accrual concept says that you account for money that is already coming to you as well as expenses. So for example, your electricity bill in a month, it may not have arrived, but you need to account for it under the accruals concept because the accrual concept says you may not have paid the cash, you may not have sent the money out to the electricity company, but you are going to pay for it. So that's the accruals concept. The next concept is the realization concept. The realization concept says that once you realize income or expenses, you must account for them. What does realization mean? Realization means it has basically come to pass. So like I said, if you've issued an invoice, you've realized that income. If somebody has sent you an invoice or sent you a bill, you've realized that expense. So we use the realization concept to account for income and expenses that we've realized. The next is consistency. In your business account, you must treat things the same thing year after year. So if you, for example, have an asset that you depreciate Yes, depreciation. I'm sure you've heard it and you've thought, what is that? So let me explain the concept of depreciation. Depreciation is basically saying, if I have this asset that I expect to last in my business for 5 years, I buy the asset, say I buy the asset for 10,000. I expect that asset to last 5 years. So under the straight line method of depreciation, I'm going to take that 10,000 and divide it by 5. And it's only 2,000 that I'm going to consider to be an expense in my business. That is basically how I account for depreciation. And what depreciation does is it takes that cost of that asset that you bought in the first year and it spreads it over the 5 years of the life of the asset. Do you get that? Yeah, great. So that's consistency. I hope you have your wine. Join me. So consistency is saying I will treat similar things the same way year after year. The next concept is prudence. Now, as business people, we must be optimistic. We must believe that we're going to do well. We're going to earn huge amounts of money. But when we're accounting, we must be prudent. We must be careful. We must be pessimistic. So prudence says we don't account for income except we've earned it. But if we expect to have an expense that hasn't crystallized, we account for it because we're prudent, we're careful. The next concept is objectivity and verifiability. We use figures that we can objectively justify. We don't say, for example, well, I believe that this asset of mine, even though I bought it for 10,000, I believe it's worth 100,000 because I love it. We can't put 100,000 in our accounts. We must put that figure that we can objectively verify. And then there's duality. The duality concept in accounting states that for every transaction, there's an equal and opposite transaction. And that's where you hear about the debits and the credits. That's the duality concept. Materiality is talking about the what's the word? The significance, the relevance of the figure. So for example, if you have a business that the revenue is hundreds of millions, you don't worry about accounting for every 100 naira or pound. What you're basically doing is you're saying this is not material, so I will join all the immaterial expenses together so I don't waste time counting little pennies. I can put them all together. And the relevance concept, we only put things that have a financial number in our accounts because that's what's relevant. So like I said, you're a jewel of inestimable value, but you don't put your value in your accounts. Like human resources in your business, you don't put the value of your extremely valuable human resources because it is not relevant to the monetary accounts that you're preparing. And last but not the least is the stable money unit. Now we have to be careful with the stable money unit concept because the stable money unit concept assumes that a pound today is the same as a pound next year, or a naira today is the same as a naira next year. And for those of us in Nigeria that see how naira is depreciating, you have to be careful. And that's why you really have to invest, because 1 naira today is not worth the same thing as 1 naira tomorrow. And another life, we're going to talk about net present value and understanding how you compute and account for the fact that naira today is not the same as a naira tomorrow. A pound today is not the same as a pound tomorrow. So those are the concepts the assumptions that we have in mind when we're looking at our money and when we're accounting for our money. Now, there are various types of businesses. For those of you that are about to start a business, you need to think about what kind of business structure do I want? And they're fundamentally three. There's the sole proprietor, where you are basically the sole person running a business. And with the sole proprietor, there is no demarcation between you and your business. You and your business in legal terms are the same. However, for accounting, your business is always separate from you. So even where you're a sole proprietor and you put money in the business, you become the person that has put capital in the business. So the business is owing you, in quotes, this money. Even though it's not a liability, it is what we call equity or capital in the business. So there are fundamentally three businesses: your sole proprietorship, your partnership, which is when you come into business with someone else and form a partnership, and the two or three or four or seven, or for some chartered partnerships up to 100 partners. And then there's the company, what most of you know. There are various types of companies: the limited liability company, companies limited by guarantee. So when you're going to business, you need to decide what is the business structure that you're going to use. And there are various things that come into play when you're talking about what business structure you will use. So let's talk about business money. For your business, there are some statements, your financial statements for your business, that are very important that you understand. The first is your balance sheet. Your balance sheet is the account, is the statement of your business assets and your liabilities. So your business assets are those assets that the business owns. Now, remember what I said at this point about the fact that your business is not you. So your business is a separate legal entity from you. And so your business owns assets. So let's use an example. Samaya starts a business and she puts 100 million into her business from her personal funds. That business now owns cash in a bank that Sumaya put in of 100 million. That cash now belongs to the business. And at the bottom of the balance sheet, the business has capital that has been put in by Sumaya. So you can see that Sumaya Limited and Sumaya are two different entities. When I'm looking at the finances of Sumaya Limited, I see the asset, cash, that's in the business, and then I see the capital that is owed to Sumaya, even though it's not a liability, because liabilities are money that is put into the business by other people that we have a legal obligation to pay them back within a particular period of time. But with capital, the owner's capital is in the business and can be in the business for a long time. So on our balance sheet, what is our balance sheet? The balance sheet is a statement of the financial position of the business at any point in time. And your balance sheet has assets, and you can have fixed assets I spoke about. Then you have the non-current assets. Those are the assets that, like your inventory, your receivables, that are not expected to be in the business for longer than a year. Then you have your current assets, your fixed assets, your property, your cars, your furniture. All those are your fixed assets in the business. And next we have liabilities. So the assets are what the business owns, and next are the liabilities, what the business owes to other people. So if you buy goods on credit, that means you haven't paid for them. You have creditors. Those are liabilities in the business that the business has to pay up to the creditors that it bought the goods from. So those are liabilities, and liabilities can be current and non-current as well. So current liabilities are liabilities that you're owing and you need to pay within a year, and non-current liabilities are the longer term liabilities. For example, if somebody puts money in your business and you give them what we call a debenture, like a loan note that you're going to pay them back in 5 years, that is a non-current liability in your business. And just like I spoke about with your net worth statement, on a business's balance sheet, you have your assets less your liabilities, and that gives you the capital or the equity in the business. And the balance sheet always balances. That's why it's called the balance sheet. So in a business, the value of the assets is always equal to the value of the liabilities and capital. So that's your balance sheet. Now, an interesting thing in business is you start the business and you have the balance sheet, and then you start doing business. When you do business, the record of the business you do from day to day usually Financial accounts are done after a year. Records your income that I already explained you make in the business, less the expenses, and you have what we call profit. Now, the interesting concept you must understand is your balance sheet is basically your opening balance sheet plus your net profit that you retain in the business gives you your next balance sheet. So as the business grows, your balance sheet gets bigger and bigger by the profit you make each and every year. If you make a loss, your balance sheet will shrink. That loss will reduce the previous period's balance sheet for to the next period. So what's a profit and loss account? Your profit and loss account, like I said, is a record of the profit you make in the business, and it's broken down into your revenue. Revenue is the income that you make in your business from sales of your goods or your services. That is money that comes into your business. And then you have your cost of goods sold, or your cost of services, your cost of sales. That is basically those things that you sold. What did they cost you to buy, to make in the business? And when you compute your cost of sales and you deduct them from your revenue, you get what we call your gross profit. That's where your gross profit comes from. Now, after your gross profit, you have expenses, what we call your operating expenses in your business. So you deduct all the operating expenses, your salaries, your electricity, your rent, and so on and so forth. And then you get your net profit. Your net profit is the profit you make after operations in your business. So you also have what we call finance costs. If you have borrowings from the bank or from creditors and you're paying them interest, that interest you pay is a finance cost. And then if you have investments, you're earning dividend, you're earning interest, you can also have financial income in your business. So your profit before tax is the sum of your operating profit plus those other finance income less the costs that you have, and other income, other expenses. Maybe you have rent that you earn from letting out part of your premises, and then you get your profit before tax. And then there's the good old tax. A lot of people get very confused about tax. It can be complicated, but just to simplify it, your tax is a percentage of your profit that you pay to the government to provide for the services that the government provides for you, for your business, for your community. And that gives you your net profit. It is out of that net profit that you then pay dividends. What are dividends? Dividends are sums that you pay to people that have invested in your business as their reward for investing in your business. And after you take off your dividend, you have your retained profits. Like I said, if you have any questions, please put them in the question box. I only have 4 minutes to go, so I'm going to run quickly through your cash flow statement. What's your cash flow statement? Like I said, our financial records are done on the accrual basis, so it's not necessarily on cash basis. Sometimes we might have some income that we haven't received as cash, we're going to receive in a later period. And we may have some expenses that we haven't paid for that we're going to pay for. But the cash flow statement is important because especially when we're borrowing, we must pay our interest and we must repay the borrowings in cash. So it's important. Most businesses fail because they run out of cash. So it's important that we keep track of our cash. And that's what the cash flow statement does. The cash flow statement basically records 3 types of cash: our operating cash flow, our investing cash flow, and our financing cash flow. As business people, we must keep an eye on that operating cash flow because we don't want to be recording, say for example, I have a business and I have a building and I sell that building. It looks like my business has made a lot of profit. Meanwhile, that was just investing cash flow. The underlying business is not doing well. So we must look at our operating cash flow and we must make sure that our business is generating operating cash flow. Enough cash must be coming into our business from our operations. So We must keep an eye on our investing cash flow as well. How much are we investing in assets? How much are we making from selling assets? And financing cash flow, how much are we bringing in from borrowing? From how much are we paying in interest payments for financing our business? So those are basically the three sources of cash flow. So what I've done is I've given you the basics for you to get started to understand your money, either your personal finances or your business finances. You must understand your income and how it's coming in. You must understand your expenses, how they're going out. You must know your net worth. And the journey to financial freedom is about growing your net worth year after year. So if you're interested in learning more about your financial freedom journey, you want to get to financial freedom fast, sign up for my newsletter, abby@abbilonge.com, and you will get regularly tips, knowledge, tools, and templates to help you on your financial freedom journey. I also do courses that you can join where you can learn more and grow your financial knowledge. So that's it. We have a minute to go. I haven't seen any questions in the question box. So let me just have a look. No questions. And so that's it. So enjoy the rest of your Wednesday evening. Get a glass of wine, some tea if you drink tea. And it's 7:30 on the dot. It was nice to have you here. Thanks for joining me. And I hope you've learned your money basics. And I'll see you next week. Bye for now. Thank you, Pearl. Thank you, Ify. Thank you, Bumi. Thank you, Temi, Aisha, Shade. It was nice to have you all here. Sumaya. Thank you, Smith Boy. It was nice to have you. Carol, Madam Soja. Thank you, Spicy. Thank you so much. Bye for now. Bye.